Alright, so we have introduced the budgetary assistance and the budgetary accounting for federal government. Now we move to the second track, which is accrue-based accounting, FASB model. The FASB deals with recognition of revenues and expenses, and is correspondingly with valuation of assets and liabilities in proprietary accounts. So we have two types of revenues. One is exchange-based revenues. The other is non-exchange-based revenues. Exchange revenues arise from sales transactions where both parties benefit. Right, this is a revenue we often have from the private sector and buy and sell. For example, revenues from service should be recognized when the service is actually performed. Revenues from long-term contracts are recognized on percentage of completion basis. Revenues from sale of goods should be recognized upon delivery of goods to customers. So these rules are exactly the same rules we have for the private sector from the FASB. And for government, we also have non-exchange revenues. These are government commands resources, but gives nothing in exchange. For example, taxes and fines. So for these revenues, a federal entity should accrue revenues when specifically identifiable, legally enforceable claims to resources arises, to the extent that collections is probable and measurable. So for example, there's a fine you receive, but should the government record a revenue? Probably not for now, because right, you still have a chance to go to the court to appeal. So the collection is not finalized. All right. Income tax should be recognized when assessed by the taxpayers, and fines and penalties may be accrued upon the expiration of the period, during which the offenders may contest a court summons, when the offenders pay the fines before the court date, when the court imposes the fine. Donations are recognized when the entity has a legally enforceable claims to the donated resources, and the amount is measurable. So these are the rules for non-exchange revenues. Examples. So we have a federal government. It signs 2 contracts to provide engineering services to a foreign government. Each contract was for $50 million. During the year, the federal agency completed 100% of the one contract and 60% of the other. It collected the entire $100 million in cash. So first of all, this is exchange-based revenues. So we're going to follow and this is a percentage basis, right? To recognize revenues. So for one contract, we recognize it's completed, so recognize 50 million. And for the other contract, we can only recognize $30 million, which is 60% of the total contract amount. Therefore, we're going to recognize revenues $80 million, and the rest $20 million will be deferred revenues. So debit cash, $100 million. Next, we have the agency accepted from a private foundation a pledge, $120,000 to fund an exhibit in a government museum. During the year, the foundation paid $40,000 of its pledge, promising to pay the balance in the following year. The pledge does not constitute an enforceable legal agreement. So this is a non-exchange revenues. It's measurable, but it has to be enforceable legally. The promise, right? The $40,000 given, paid, for sure it's revenues, but how about the rest $80,000? Because it's not legally enforceable, it's not revenues yet. Okay, so it's a deferred revenues. We credit revenues and we credit deferred revenues, and debit cash and debit pledge receivables. Unless it's legally enforceable, then we can recognize a revenue. Accounting for plant and equipment. The FASB groups assets into two categories: the general assets and the stewardship assets. And for the stewardship assets, we have land and heritage assets. So first, the general assets. General assets are comparable to those of businesses. So for general assets, they are capitalized and depreciated over the useful lives, except for land. So we need to include assets as general assets if they're used to produce goods or services, are used in business type activities, and are used in activities where cost can be compared with other entities. For example, the federal hospitals, the assets are used in these activities, and cost will be very similar or be comparable to the other hospitals. So these assets will be recorded as general assets and are depreciable. Military assets. Military assets are also general assets. They include aircraft, ships, vehicles, tanks. In fact, if you check the financial statement, the military assets, or the assets held by the Department of Defense, take the majority of the total the U.S. PP assets. Okay, and their useful lives, they are depreciable, but their useful life become much shorter during times of war. And prior to May 2003, they were accounted for as other stewardship assets and expensed as incurred. We start to capitalize military assets after May 2003. Space assets. These are assets used in government's space programs and are accounted for as general assets. Now, how about stewardship assets? First, land. It includes national forest, national park. These are almost 28% of the U.S. the land. And they are neither used in government operations nor held for sale. Okay? It is not capitalized and not reported on the balance sheet. If the government acquire additional land, it is expensed as acquired. Condition of the land is reported in the required supplementary information, RSI, in the financial report. heritage assets. These are assets that has historical, natural, cultural, and educational or artistic significance. For example, museums, right? Monuments, historical sites. And some of these assets might still be used. For example, the White House is still used, right? But it is a true heritage assets. So the FASB rules that all multi-use heritage assets will be recorded as general assets. They will be capitalized. And depreciated over their useful lives if they have multi-use. So only the true heritage assets are not capitalized, like the museum and monument. So these assets will not be capitalized and should be reported in the stewardship report. Conditions of these heritage assets is reported in the required supplementary information in financial reports. So we know in FASB, land is recorded as a PP asset, right? And in the most recent FASB update, it requires that the federal government to not capitalize land for even if it is used for operational purposes. So this update make the accounting for land to be consistent across general assets and heritage assets. So let's see a few examples. We have a monument to honor the sailors who served in the U.S. Coast Guard. Okay, an indicator how it is recorded. A, capitalized and depreciated. B, capitalized but not depreciated. C, expensed as acquired and described in notes. Alright, for sure this is a typical heritage assets, so it will be expensed. C. Land to be incorporated into a national forest. Right, this is a typical stewardship land, so the choice is C. A train station that will serve as both an operating office buildings and a historical monument. So this is a typical multi-use assets. It's half heritage assets and half general assets. So it will be treated as a general assets and will be capitalized and depreciated. Choice is A. Land on which will be built an office building. Okay, although it is used for operational purposes, right? But the land will be expensed as acquired, according to the FASB update. Operating rooms, equipment for Veterans Administration Hospital. Right, so this is a typical general assets. It's comparable to other hospitals, so will be capitalized and depreciated. A Navy fighter plane, right? This is the military assets, will be capitalized and depreciated. Next, accounting for inventories. Inventories can be valued at either historical cost or any other valuation method that approximates historical cost. Okay, this second rule helps the Department of Defense establish opening balances, because before May 2000 2003, right, all their inventory, all their assets are not capitalized. So to help them build opening balance after May 2003, they can revalue those inventories in order to set up the opening balances. But for all other inventories, they will be recorded at their historic cost, which is the price we pay. Other types of inventory, such as operating materials and supplies, and stockpile materials, are also valued at historical cost. Accounting for human capital. Investment in human capital are intended to increase the nation's productive capacity, and the cost of education and training programs should be capitalized as incurred and amortized over the periods to be benefited. Right? And the reported expenses for physical assets will be reported over the life of its assets. Alright, so these are the theoretically based. And we know the FASB, even for the private sector, we do not recognize human capital, right? So the FASB also rejects the notion of capitalizing investment in human capitals due to the practical difficulties. Instead, it will be disclosed in the required supplementary stewardship information. But after 2009, this RSSI is also eliminated. Okay. So in summary, we do not capitalize any investment in human capital assets. Liabilities and expenses. Government liabilities are attributable to events. And events include transactions and happenings of consequences involving the government. So we have two types of liabilities. Liabilities from transactions and liabilities from the happenings of consequences. So first, liabilities from transactions. And it could be from exchange transactions and non-exchange transactions. And the FASB requires liability from these transactions to be recognized for exchange transactions where each party gives something of value, and for non-exchange transactions when the payment are due. Right? So for if government purchase some goods, when those goods are delivered, the government has a liability, recognize a liability, because the other party gives something of value. Right? And for non-exchange transactions, the government is going to recognize a liability when the payments are due. For example, we're going to talk about that, this applies to the social security payment. Government is going to recognize the liability when the social securities are due. Okay. We also have liabilities from happenings of consequences. And again, we have two types of happenings. Government-related events. These are accidents for which government is responsible and required to reimburse for the damage. So liabilities and related expenses are recognized as soon as events occurs and the anticipated outflows are probable and measurable. Right? For example, the government, because of the design flaw, the bridge, right, collapsed, and because of that, there are lawsuit. These liabilities will be recognized. We also have government acknowledged events. These are not caused by the government. These are occurrences for which the government is not responsible, but provide relief to the victims. For example, natural disasters. Right? So the liabilities and related expenses are recognized when the government formally acknowledges financial responsibilities and an amount is due and payable as a result. Okay? Both are necessary in order for federal government to recognize as a liability. Acknowledged, and then the amount is due and payable. Only acknowledged, no, it's not a liability. Acknowledged, then measured the payment, and we have the due date. Alright, let's see a few examples. So the government ordered 10 military aircraft from the manufacturer at a cost of $100 million each. During the year, it received 5 and paid 2. Their expected useful life is 10 years. So we're going to indicate the amount the federal government should recognize as an expense during the year. So first of all, right, this is the exchange transaction. And the government received 5 and paid for 2. Therefore, the government should recognize, right, the payment of the 3 aircraft as a liability, which is $300 million payables. But there's no expense, right? So where does the expense come from? The expense comes from depreciation, because the government has been used 5 aircraft for that year. It's going to recognize depreciation, and based on the total historic cost, $500 million divided by 10, we're going to get $50 million depreciation expense for this year. Okay? Next. As a part of food relief program, the government authorized direct grants to individuals and businesses. And during the year, it approved grants totaling $400 million, of which it actually paid $240 million. It expected to pay the balance which is due and payable in the following year. So first of all, for this year, right, what is a government liability? Right, the acknowledged $400 million grants, of which they paid $240 million, and the rest will be due the next year. So for this year, the government's liability will be $240 because it's due this year, and they have paid for that. So we debit expense and credit liability to reduce the $240 million liabilities, and the rest $160 million because it's due the next year. It's not this year's liability. Okay, we do not recognize expense. Therefore, the total expense for this year will be $240 million. And during the years, the employee of one government agency earned pension benefit having an actuarial present value of $30 million. The government made actual payment of $23 million to employees who had previously retired from the agency. So what is the total expenses? So the total expense should be $30 million, which is the total actuarial present value of the pension, because this is a exchange based, right? On the one hand, employee provides service, and the government is going to give them pensions. So because these has been earned already, the $30 million has been earned. Therefore, the total amount will be recognized as expense and a liability. The government paid $23 million, so they reduced their liability by $23 million, but still there's $7 million a liability, existing liability. All right. Social insurance programs. The FASB specified that social insurance costs should be accounted for as non-exchange transactions. Reporting entities, therefore, should recognize liability and related expenditures only when the payments are actually due. But the FASB also requires their extensive disclosures in the financial statement, okay, especially in the required supplementary disclosures, and also the financial statements, in which we have long-range projections of the social insurance program. Direct loans. Federal entities make low-interest direct loans and guarantee loans made by banks and other institutions. The FASB directs that when a subsidized direct loan is made, the government should recognize as an asset the present value of its estimated net cash received, including both interest and repayment principals, and also should report an expense equal to the difference between the face value of the loan and the present value of the estimated net cash received. So here we have an example. So the BDC made a loan of $100,000 to a company. Interest rate was 6%, and loan was payable over the 3-year period. Equal installment of $37,411 each for 3 payments. At the time of the loan, the prevailing treasury interest rates for a loan of comparable maturity were 10%. So if you go to the market, you pay 10%, but if you have a loan from the government, the interest will be 6%. Obviously, this is a subsidized loan. And because of that, the government is going to absorb the cost. Okay? So we debit loan receivables, which is the present value of the 3 payment at 10% discounted at the market interest rate. So $93,036, which is below the face value of the loan amount. The difference between these two is the government's expense. So debit loan subsidy expense, $6,964. Okay? Right, so once we have introduced the FASB accounting for proprietary accounts, we talk about financial reporting. So federal government-wide reporting entities. Because we have so many agencies, right? So should we consolidate, report all of them in the financial statement or not? So first, let's understand what entity to include in the financial statement. So the per FASB statement number 47, the federal government-wide reporting entity should include all organizations in the budget. Okay? So they use taxpayers' money, and majority owned by the government, controlled by the government, and would be misleading if they are excluded. We also need to determine whether the entity should be consolidated or whether they will be disclosed. We're going to disclose entities that have a greater degree of autonomy. So they're not fully controlled by the government, or organizations may be owned or controlled by the government as a result of regulatory actions or other intervention actions. If the relationship is not expected to be permanent, such entities generally would be disclosure entities. Okay, for example, in 2020, the Federal Reserve System, okay, it's a disclosure entity. It's closely related to the federal government, but it's not controlled, right? So what is controlled? The Fannie Mac, Freddie Mac, they are actually owned and controlled. However, this is because of the intervention actions from the last financial crisis, and it's not expected to be permanent. Therefore, Fannie Mac and Freddie Mac are disclosure entities. Okay, other disclosure entities like the Amtrak, right, the railway company, is also a disclosure entity. So like the state and local government, we also have the component reportings if the specific agency does not meet the qualitative or quantitative criteria. So they will be combined and reported in component reporting. Examples. The entrepreneurial business administration was established by the Congress to promote the investment in innovative small businesses. The agency is financed with a congregation, appropriated funds, and is considered a unit of the Department of Commerce. Obviously, this is they use the taxpayers' money in the budget, right, controlled by the government, right, owned by the government. Therefore, this agency will be consolidated. Next, Congress and the President established Delta corporations as non-for-profit organizations to promote the export of U.S. robotics technologies. The corporation is governed by a 5-person board of directors, 2 of whom are appointed by the Secretary of Commerce, and 2 of whom are named by the Robotics Industries Associations. The corporation is funded from fees assessed to members of the association. The corporation is audited by the Government Accountability Office and must submit annual report to the Senator and House Commerce Committees. If you look at these information, yes, it's closely related with the government, established by the government, probably controlled by the government, but it's not in the budget. It does not use the taxpayers' money. It collects fees. Okay, so very likely this will be a disclosure entities.